I've got 6:59 here on the clock, so we're going to go ahead and get started, go through a couple housekeeping things. First off, I want to say welcome to this week's virtual breakfast session brought to you by the MSU Extension Field Crops team. My name's John Laporte. I'm going to be the host and moderator for this week's session. A couple housekeeping things. First, please mute yourself during the presentations. We also ask that you please sign in with your first and last name. To do that, click on the participation list that you can find on your screen. Find your name and hover over it. And there's an option to click more and then rename. So we'd like to see that first and last name to kind of help us identify questions and make sure we're answering stuff for you folks. In terms of questions, ask those in the chat box found at the bottom of the screen. We're also going to have a monthly evaluation that will be in the chat at 7:30 today. We ask you to please fill this out to help us improve our programming efforts. And then also at 7:30, we're going to have the RUP and CCA codes will be put up. MSU Extension programs are open to all. The collection of demographic data from program participants is an important and mandated aspect of all Michigan State University Extension programming. This is voluntary, and the information that you provide will not be used in any way to identify you personally, but rather as a member of a group that participated in this program. A link has been shared in the chat. We ask that you take a moment to fill out the information. Again, a monthly evaluation will be in the chat at the end of the formal session today. We ask you to please fill this out to help us improve our programming efforts, and thank you very much for that. Getting right into it today, our guest speaker is Dr. Matt Gammans. He's an associate professor at MSU. Going to be talking to us today on pricing corn, soybeans, and wheat. And Matt, I'm going to go ahead and stop sharing here so you can go ahead and get your slides up.
Great, thank you, John. Although I've not been promoted, I'm an assistant professor, so much more lowly than John is trying to make me seem. Thank you everyone for joining today. So I know that you already got kind of your great WASDE update from Arlen Sunderman a few weeks ago. So today I'm not going to talk too much about kind of what's in that new report. I'm just going to give a kind of a quick refresher of some of the highlights and then move on to thinking about how some of our grain marketing tools kind of might fit into this type of price scenario that we're in. So new WASDE report was out July 12th. All right, yeah, so on the demand side, not a big update from the June report. So forecast is for big feed and residual usage relative to last year. And there's been some kind of back and forth on this by some of the analyst groups, but probably can count on some export demand from China, but likely not as strong as last year. Last year was really kind of with some of the weather events in the Ukraine, it was really probably kind of a one-time deal in terms of just how much corn China was looking for. On the supply side, a lot of the groups that I follow at least were expecting the USDA to cut the corn yield estimate in the July WASDE, and that hasn't happened. So they kept their yield forecast where it was. There was cuts to predicted South America corn production, actually a small increase in Argentina, but that was offset by a large cut to the Brazil forecast. But I think there's still some thinking that we might see some yield cuts going forward, especially if kind of the drought situation you can see here on the right side of the screen. In Minnesota especially, Minnesota has a lot of acreage, and as of a few weeks ago, we're having some pretty serious drought problems. So there's potential for some yield cuts there. Not much changes in terms of the soybean picture in the July WASDE. So this is not from the WASDE report. This is kind of just moving on to a general outlook of where prices might be heading. And the purpose of this slide is really to try and help people think about kind of what the distribution of prices might look like. So this comes from FarmDoc. It's a tool that they provide. It's based on kind of just a really basic model of options. It's the Black-Scholes model. So doing that, they're able to put together a distribution of what that December's futures contract might be trading at as we get to November. I think the key takeaway here is that there's some real downside risks. So there is definitely some real possibilities that the high prices that we see right now kind of go away. So looking at kind of a $1 price decline from what the December's futures contract is trading at today, this model says a 20% chance of that happening. So I mean, 549 is what it's trading today. You know, you take $1 off that can easily be the difference between kind of hitting a break-even price and not keeping price. Obviously, that's different for everyone, but there's some real chance that prices go down. So kind of the moral of that story is, if you haven't locked in any of the new crop, it might be time to think about kind of at least getting some of that production locked away at the prices that are out right now. And it's more or less the same picture for soybeans. So if we're thinking about a $1 price decline, these models say a 33% chance of that happening. A $2 price decline, so that's a pretty big cut, is 15%. So soybeans, there's also some potential for upside too. So what we'll talk about kind of in the rest of this presentation is tools where you can lock in some of your production at these prices right now, which are pretty good prices, and maybe still leave some chunk of production open to maybe get some of the upside benefit on the futures market. So yeah, so sorry, this is a November's futures contract. So just as a general note, and all of you have seen this year, these futures prices, they can be really variable, and that's particularly true this year. We've seen really big swings in the pricing. So that's big chance for upside, but also really big chance for downside. So you kind of don't want to have it all in one place. You want to kind of spread out your selling to kind of make sure you might not get all of the high price, but you don't want to get all of the low price either. So this is from a look at basis. So what I show here is for the thumb up in Huron County, but these general trends hold throughout Michigan. So this is kind of the general trend in corn basis that we're seeing. And this is trading on a September's contract. So this is old crop corn. Basically what happened is that the cash price didn't change too much as we went from the nearby contract being July to the nearby contract being September, but the September contracts are trading at a real discount relative to July, and we saw kind of a rise in basis to make that happen. So the basis this is a really strong basis. You can see I plotted the historical basis here in blue. So this is an average over the past 3 years, and you can see we're way above that. So really strong basis. Definitely some reason to think about trying to lock in some of these basis numbers right now. So that's corn basis. And again, I'm starting to sound like a broken record, but the soy story is pretty similar. So really strong basis in soybeans as well.
Matt, with that in mind, one of the questions that we got in the chat was looking out into 2022, should producers start considering pricing some of that production as well, noticing where some of these basis numbers are? Does it kind of go out to that level as well?
Yeah, so you can, so what's shown here is the basis on a September's contract. So if you want to kind of think about locking in basis farther out, you want to be looking at the basis that's on that contract, and try and compare that to the historical numbers that you're seeing. But in general, yeah, I don't necessarily think that that's a bad idea to take kind of just a small chunk of your production. And I know, John, you're going to talk a little bit about kind of selling up to your insurance level. I don't think that's a bad idea to look a year out and try and lock in, some tiny chunk of that production now. But yeah, I want to just emphasize that these basis numbers are different than the basis numbers that you would be locking in if you were kind of trading a year out. So kind of having just done a kind of whirlwind tour through the corn and soy outlook, this is really the meat of today's brief talk is how to improve your marketing plan. So John and I have put together an article that is going to kind of hit the press next week, I think. And the two goals that we're really want to emphasize is getting a good price and managing risk. So these are two different goals. So, to manage your risk, you might be willing to sell at a lower than what you think is a good price, just to try and make sure that you don't end up being forced to sell because of, storage constraints or anything else at a really bad price. So what's a good price? No, this is different for everyone. So doesn't have to be the peak price. If you're getting an above average basis and an above average futures price, I would call that pretty good. If you can lock in each of those at a time when they're relatively strong, that's a good situation. Whether something is a profitable price, obviously that depends on your cost of production. And there's kind of tools that are available through MSU extension to try and kind of give you an estimate of that. But so we definitely, you want to try and lock in a good price, but also we want to think about kind of breaking it up so that we're managing our risk. So today I'm going to go through some simple examples, kind of keeping in mind the scenario that we're in, which is pretty high futures prices and pretty strong basis, and kind of talk about forward contracts, basis contracts, and hedge-to-arrive contracts. So these are three of the simpler tools. We're not talking about kind of options and calls or, executing a hedge yourself. These are pretty simple to execute, and if you use a combination of them, it can be kind of a really nice strategy, a really nice simple strategy to price your grain. So I know that this is probably, super review and way too basic for some folks, but probably I think there's interest out there in having a review of some of these as well. So this is, the simple equation of cash prices. It's two things. It's basis and it's futures price. And what these tools allow us to do is to allow us to lock in these separately. So if we like the basis and we don't like the futures price, well, if we sell cash, we're kind of, we're getting the basis that we like, but with a futures price we don't like. If we use a basis contract, we can just lock in that basis that we like and kind of leave the futures price to hopefully strengthen in the future. So forward contracts, this is kind of similar to selling cash in that you're locking in your basis and your futures price at the same time. The advantage of that is that you know the price, the total price that you're going to get right at the time of sale. So if it's a good price, if you're locking in a basis that you like and a futures price that you like, there's no reason to look back. You can, set aside a chunk of your production to forward contract, and, you're kind of have that peace of mind that, no matter what happens, at least some of your production is priced at a nice level. Some disadvantages, risk of ending up being oversold. John's going to talk more about that in a minute. Sorry, the font size changed, but I want to just emphasize this kind of quick example down at the bottom. So this is, I was looking at Anderson's just last night. And, today you could lock in a price of $4.99 on a December's contract. So that's a $5.49 December's futures minus 50 cents basis. So you would be locking in both of these components. So you'd be locking in that futures price of $5.49 as well as the 50-cent basis. And that's for delivery in November. So kind of if you plan on having an earlier harvest, you'd have to make sure that you have capacity for storage between harvest and November 1st. So so this is kind of, we're going to keep this in mind as our kind of baseline scenario is this forward contract on a December's contract as we talk about the basis contract and the hedge-to-arrive. So I recycled this slide from a talk I gave over the winter, and this is straight from ADM's description of what a hedge-to-arrive is. It's really, the principles of it are the same as a hedge in a lot of respects, but what's nice about it is that you don't have to be sending in margin call money. So kind of all of that is handled by the elevator that sold you the H2A contract, and you're locking in your futures price and allowing the basis to potentially strengthen. So this is something you want to do when you like the futures price, but you want to see if basis can potentially strengthen. And if you have access to cheap storage, and you expect basis to strengthen a lot seasonally, as it often does. You can go back to historical patterns of that to see that. This is kind of a good way to take advantage of that storage. So I'm sort of starting to get tight on time, but I'm going to walk through kind of just a simple example here. So let's look at that same December's futures contract, where we're at 549, 50-cent basis. So that 499 is the forward contract price. But instead, we're going to set up a hedge to arrive. So we're going to lock in that futures price, but we're not going to lock in the basis. So let's say we get out to October 15th. The December's futures price has gone up to 580. Maybe it's a little bit of a bummer, but it actually doesn't affect us at all. So we've already locked in the 549. So whatever happens on the December's futures, not really our business at that point. What is our business is the basis. So the basis has strengthened in this kind of hypothetical example from 50 cents to minus 20 cents. So that's a 30-cent win for us, minus some fees. So these are fees that you would pay the elevator for selling this contract, and you get a net price of 527. So in the scenario where basis strengthens, and if you were kind of looking farther out, you'd want it to be strengthening more than your storage costs. This is going to be kind of a better price than the forward contract. So then a basis contract, we can think of it as kind of just the opposite, right? So with the H2A, we're locking in the futures prices, hoping that basis strengthens. Here we're going to lock in the basis and hope that the futures price improves. The key downside of this basis contract is that the futures prices are there's a lot more downside risk on a futures contract price than on a basis. So, it's not unheard of to see swings of, $1.50 or so on the futures price. Those sorts of swings in basis are pretty rare. So there's definitely kind of more risk as you get out kind of in these big price swings. So we're going to look at the same hypothetical prices that we looked in the H2A. But now we're locking in that 50-cent basis. So we're not getting that strengthening in the basis, but we are now getting that strengthening on the December's futures contract. So that 549 to 580. Oh, and it looks like I didn't go all the way to the net price here. Sorry about that. But we get that 31-cent improvement in the futures, but we don't get the advantage of the strengthening basis. So the key takeaway here is not that kind of one of these tools is the right answer. It's that you can use them all to manage your risk. So, if you sell a share of your crop, you can think about, a quarter of your crop forward contracting, a quarter of your crop H2A, and a quarter of your crop basis contract. Prices can go anywhere, and kind of your gains from one are going to offset kind of your losses from the other. So by using a combination of these, and I'm not saying that a quarter is the right ratios, but by using a combination, you can really mitigate your risk. Important to keep in mind is that basis contracts are the riskiest because the futures prices are just more volatile than the basis. So I think what a basis contract is nice for is if you're sort of worried that you just have a hunch that prices are going to kind of go to the moon or something, and you don't want to miss all of that upside. You can contract a big chunk out with a forward contract or an H2A, and then set aside kind of a smaller chunk of production to try and hopefully take advantage of, if there's a big price increase as we get into the fall, like there was last year, you can still get kind of some profit off of that. So that's just kind of a quick and dirty overview of 3 tools that I think are really nice and really nice to use in combination. So I know I sort of went over. I'm sorry. Take it away, John.
That's okay. We'll kind of go through these quickly. In terms of thinking about the insurance coverage that you have as a target to use, we just want to highlight for folks that when it comes to crop insurance, most folks have a revenue protection policy. And that policy uses a base price that sets a floor, creates a revenue guarantee. And the key thing to remember is that the default on that policy is that the final revenue guarantee actually recalculates to use the harvest price. So if your harvest price does go up higher, it replaces the base price and increases that revenue guarantee. And so this feature actually offers some protection when you're looking at pre-harvest marketing grain. But the question we often ask as we go to the next slide is, how often is that used in marketing decisions? If you want to go ahead and advance the slide there, Matt. And so we just want to kind of showcase that, how often is that coverage level used? Keeping in mind that most revenue policies cover 75 to 80% of production. You can see here on this graph, this green line, this is from USDA Economic Research Service, that kind of a 20-year period. You can see that for crops, we're only talking about somewhere between 20 to 30%. And really in the last decade, we're not even reaching 25%. So that's all crops. All commodities are a little bit less than 40%. Go to the next slide, Matt. We can kind of see, as you look at the center of this graph, the question is, where does corn and soybeans fit into this? Corn is roughly about 12%. And you can see it really hasn't moved a whole lot in that 20-year period. Soybeans have increased a little bit from about 14 to maybe 17 or 18%. So well below the 75 to 80% level. And so on average, what we're trying to showcase here, folks, is that there is an upward potential that across the nation, we don't really see a lot of people utilizing that full coverage protection of their insurance. Now, of course, the big question is, what if we do that? We can't cover the contract. So we go to the next slide. We start to ask the question of how much should we kind of actually market here, and thinking about concerns. Well, quick example, we got 600 acres of soybeans, 40 bushel per acre average production, or actual production history, 75% coverage. A little bit of quick math, you've got 18,000 bushels. The question is, how many of those should we market? The actual answer is the 18,000 bushels. Matt, go ahead and go to the next slide. We'll kind of highlight, the big concern here is, what if there's no yield and prices go up? We've missed this opportunity, and now we've got to buy back bushels. And so real quick here, if we pre-harvest market that 18,000 bushels, say at a price of $9.54, we're looking at about $171,000 in expected revenue. But August turns dry. We don't have the bushels. We're short. We've only got a little over 13,000. We're going to have to go out and buy the rest of these bushels, about 4,800 in this example. The price has gone up. We're not $11, so that's going to cost us almost $53,000 to go out and buy those bushels. Well, your revenue protection actually adjusts with that harvest price. If you keep that option in there, again, that's the default, and that's based off of futures. So say it's a $11.25 future price, your insurance check is going to shoot you out $54,000 that you can use to go out and buy those bushels with. Now, in this example, we highlight you're looking at a gross return of 172,000, almost 173. But this is not always the case where you're going to see a profit. This insurance does not guarantee you a profit level. Rather, what it does is try to provide some cost reduction when you've got some production or market opportunities that you've lost that's out there, and something we want to highlight for people. There's still basis and opportunity risk out there. This ties back into the tools that Matt showcased. And what we just want to kind of emphasize is you've got that ability, if you're using that insurance, to give yourself some protection to go up to that coverage level if you feel those prices are good, if you think you want to lock in some futures or basis in there and try to get some of that pricing locked in. You've got the ability to do that with a fair amount of your production. And if things kind of don't turn out right, poor production, prices go up, you've got some additional risk coverage there that kind of helps with that you want to kind of think about as you're doing some marketing strategy. Man, I think that's yep, I think that comes back to you.
Sorry. Yep, that's about it.
Okay.
Yeah, we can skip the closing thoughts. They're not that deep. But yeah, we'll pass it over.
All right. So at this time, we've got let's see here, one question here in the chat here. Mark Seaman asks, Matt, it seems that the very low carryout for both corn and soybeans will kind of set a floor price. Additionally, the weather issues that you mentioned in the western corn region should also limit the downside risk. Would you please share your thoughts on why the market would overlook these factors and possibly move lower?
Yep, I think there's reason to be optimistic for exactly those reasons, and there's reason to think prices could go up. But you have to remember, I mean, these fall contracts, these are taking in all of these factors. So people are already thinking about these potential weather risks and these and the low carryover when these contracts are being when the market is deciding the prices of these contracts. So these are kind of already worked into the system, and if things change dramatically, if you have a really good August for yield, then things could change and things could quickly change. And then a lot of this too, it gets into kind of broader politics and international dimensions where, we don't know what China's demand is going to be. So people kind of have expectations, but, for a long time, they didn't demand any corn from the U.S. So there's kind of no guarantee what that export demand will be.
Thanks, Matt. We actually had a question for Jeff asking how will the changing weather patterns impact tar spot spread? And I know that Marty is on the call, so that might be a dual combination to ask the two of them.
And I'll start because I'm going to hand it off to Marty, who's the expert to that. And actually, Marty was wondering too as well about this weather pattern. Are we going to see some increases in moisture, in dew duration, dew events? And I think the answer probably is no. That the humidity with this air mass and with what we're going into is much drier. And as a result of that, I think we might even see less in the way of dew and dew duration. It depends some on what the coverage of the rainfall is this weekend. And right now, I'm thinking it's going to be limited. That a lot of areas will remain dry. So that actually would be probably a positive. And then I'll turn it over to Marty, who actually is the expert on this one, and see what he thinks.
Thanks, Jeff. Yeah, that's certainly what I was wondering about, moisture. And so just briefly, tar spot's going to be favored by any sort of leaf moisture events that we have, be it rainfall. If we're irrigated, obviously we're at higher risk. And then that dew period is also really important. Anytime we're getting around about 7 hours or so of leaf moisture, that's supposed to be quite favorable for tar spot, for that fungus to infect the plant. In terms of spread, tar spot is very widespread across the state, and it's really just a question then of, what the upcoming conditions are going to be here in August in particular. This is a county by county map of where we've confirmed tar spot and where we've had reports for historically in grey there. And then this year in that yellow color. So it is present or has been detected in a lot of counties this season. I would fully expect that, we could find it in most of those other counties that are already have a grey color to them. It's just a matter of diligent scouting. So I'll leave it at that.
Marty, I found a leaf yesterday that has what I think is tar spot on it, and I'd like to have that actually confirmed by your lab. How should we go about sending samples to your lab in a county that hasn't been confirmed yet?
Yeah, if it hasn't been confirmed, we would very, very much like to have a leaf sample sent into the MSU Diagnostic Clinic. You can also send me a picture of that. Tar spot is fairly distinctive. There's certain features that I look for to help distinguish it from other leaf diseases. So a pretty reasonable quality photo can also help out significantly.
So Marty, the next question is, what percentage of tar spot should be on these leaves in order to initiate a spraying of the field?
Right.
That's the question I get, and you get often.
Yeah, so I went through this last week, right? So in the photo behind me, we went in there and we sprayed right at the very initiation of symptoms. From that, this is the yield data that we got out of that particular trial, where we were seeing somewhere between 25 to 50 bushel protection by spraying July 17th last year. I do want to say that this is on the susceptible hybrid, and it was an irrigated location. So those are a couple of pieces of the puzzle that are really important. Like, what is the leaf moisture again? And that's why, I was asking Jeff about dew periods and how frequent they're going to be. And then hybrid susceptibility. If we're dealing with a hybrid that's more susceptible, there's more to protect. If it's fairly resistant to tar spot, you're not going to get as much of a benefit from that. Honestly, determining that threshold is difficult. What I will say is that vegetative sprays really seem to be too early and are not going to do a great deal for managing this disease. So again, the data that's up there now is from R1 spray timing. We're trying to finesse that timing more. And I also presented some data last week about these different timings, looking at different spray points during the season and seeing how they protected things. We really don't want to be waiting until very late in the reproductive stages. So I'd say, really late August, we're really getting too far in to really protect too much. I think generally between R1 and R3, there certainly have been instances where people have sprayed on the 20th of August and seen a 20 bushel protection when tar spot was just picking up in that point of the season. So you do have to be proactive in terms of knowing what's on your field. One of the tricks is that tar spot is hard to scout for. You're looking for these little black specks on the plant, right? They're not particularly easy to see. And it can develop pretty quickly. We can go from a few spots to many spots, in a couple of weeks, really. So that's part of the trick there and the challenge. That answer your question?
Sure does. Thank you, Marty.
Yep.
So John, we'll turn it over back to you. And did you have any more thoughts or information on the marketing aspect?
I think we got through most of our material. Matt, did you have any closing thoughts you want to add here as we look for more questions here in the chat?
Well, yeah. So we have my few parting thoughts slides that we didn't get to, but again, not too deep. I think we talk about this in the article that's coming out too. But don't let the perfect be the enemy of the good, right? If you have a good price, you have a good price. Like, there's no need to beat yourself up about hitting the high. If you can lock in prices that are good, that's a good strategy.
I don't see any more questions in the chat. If you do have questions, feel free to put them in the chat here, either for Matt, Jeff, or even Marty. Happy to answer any of those that you folks have got out there.
John, we talked a little bit about what some of the higher prices for inputs how that will affect our marketing strategy. Have you thought about that?
Yeah, one of the things that Matt and I actually have talked about that a little bit, as you're thinking about, Matt mentioned cost of production at one point during the presentation. That's kind of where you want to start thinking about where your break-even price is as you're trying to figure out a good price. And that number is going to fluctuate now that we're seeing some higher costs, both in terms of maybe you had to pay a little bit more for fertilizer this year than what you'd originally maybe budgeted. So how does that affect that good price that you're looking for? And earlier we had a question about pricing into 2022. That's a factor as well, because as we all know from historical, when prices go up and follow market prices going up, market prices can come down pretty quickly, but those input costs kind of are a little bit slow to follow suit. So kind of factoring that into your budget and projections and figuring out that good price is really important, because that number is going to fluctuate. And if you're looking at a higher price, well, that's gonna change that good market price you're looking for to try to lock in some profits.
Yeah, I agree with that. I can't help it. The economist in me, if you're talking about the crop that's coming up, your inputs are in the past. I mean, that's a sunk cost. I mean, there's no use, what you paid is what you paid. Definitely when you're thinking about your input choices, that's something to be thinking, to keep an eye on market prices to make sure that they're gonna pay off. But once the crop is grown, kind of what you spent on inputs, you just want to lock in a good price that is, the best that the market will give you. There's kind of nothing more to be done about inputs at that point. But
that's a good.
Start looking at locking in some of our inputs for 2022.
Yeah, that's a good point. I don't have sorry, I don't have the input prices. I did not look at those this morning. I don't actually know the trends in getting inputs bought for next spring. Yeah, that's a good point. That's another way that you can kind of reduce your risk by locking in input prices that are profitable. And this ties back to John's point, where if you know your cost of production and you know how kind of the money flows in and out seasonally, you're going to be able to take advantage of good prices on inputs and take good advantage of good prices on outputs. And so, yeah, kind of building up to that knowledge of your operation about when the money's coming in and when the money's going out. But yeah, sorry, I don't have a good answer on locking in inputs.
I would just add to that is, as you think about the key thing that Matt mentioned, there was seasonal pricing, knowing what you've historically had, having an idea of what we've been seeing more articles out lately on kind of some price forecasting, and wish we had that in front of us right now to share that. But what you kind of want to look at is what the expectations are, kind of the same way we're talking about in terms of market prices for grain. What are the market expectations? What have you seasonally had in the past at certain points? Is the expectation for those to go higher? And that becomes a decision of, do you lock that price in now, or are the expectations maybe it's going to come down? It's a tough choice that every producer has to go through. Same as with grain marketing. You're trying to lock in what you think is a good price based on the information you've got of what to expect. Yeah, we don't seem to have any more questions here, so we'll go ahead and wrap things up here. Phil, any parting things here as our main coordinator on the program?
John, I just want to say thanks to both Matt, Marty, and Jeff, especially being out of state, for joining us today. I thought it was a good reminder on marketing, and I'll look forward to next week. Thanks for your help.
No problem. Thanks for coming out, folks.